All right, guys, I'm going to give you a quick technical video about how to trade, and I'm going to give you a technical edge in the market based on some stuff from Coolomaji. Did I learn it from Coolomaji? Not exactly. I actually learned it from this guy who explains Coolomaji better than Coolomaji. And let me find his channel right here. Okay, so this guy, he has made so far, well, first off, he makes really good videos about like actually profitable traders and how they trade and what they look at and fundamentals and technicals and how they enter and how they manage positions. He's made this video and he's made this. So he's made two Coolomaji videos, a 2-hour long one and a 1 hour and 1.5 hour long one. And he breaks down Coolomaji in a very simple way to help you understand how he trades. Okay. So I'm going to try to explain in brief detail the technical entry for Coolomaji and what he does. But first, I'm going to have to explain to you a thing about risk to reward and taking partial profits, and why there's a lot of misconceptions about taking partials and what you're actually supposed to do when you take partials. Okay, so let's say you have 2 contracts on. Now, general probabilities dictate that if you took a 1-to-1 trade, 50% of the time, roughly, it's going to win, and 50% of the time it's going to lose, right? Okay, so if you're taking a partial profit, though, with 2 contracts, so let's say you have a trade, this is your system. You enter a trade, you take 1 contract off at a 1-to-1 and 1 contract off at a 1-to-2, okay? But when you lose, you're losing both full contracts at a 1-to-1, correct? I'm going to show you why that doesn't work. If you think about it, think about this. 50% of the time, you are winning 1 contract. Should I write it out? I'll write it out. %50 of the time, lose 2 contracts. I'm going to bold it. Whatever, it bolded the whole thing. That's stupid. Now, forget thinking about the next partial. Is this a profitable strategy? If half the time you win 1 and half the time you lose 2, is that profitable? No, exactly. Okay, so now you see why you cannot take a partial profit at 1-to-1 when you have multiple contracts on. Oops. That's not what I'm trying to do. Okay. So where you take your first partial is actually dictated by your position size, how many contracts you have. And this is, of course, now after this, you will see why you need an edge in the market. You can't just use smart money management to make money in the market. You can't. Okay, that's like trying to use smart money management to like manage like a roulette table. You'll still lose in the long run, right? Unless you have an edge in the market, you will not make money. Okay? Your first partial is dictated by the number of contracts you have. So let's say you have 2 contracts. That means your first partial is at a 2-to-1. So forget about this thing. Your first partial is this, if you have 2 contracts on. If you have 3 contracts, where does your first partial need to be? This is going to overlap into the chart, but whatever. Yep, that's right. In order to have an edge, this, I'm going to take that away. In order for you to be profitable, if you have 3 contracts on, think about it. If you're only taking 1 off, like let's say you were taking 1 off at a 1-to-1 with a 3 contracts, that means 50% of the time you're losing 3 contracts, and 50% of the time you're only taking 1 contract. Okay, then you could say probability theory dictates that 25% of the time though you'll win a second, and 12.5% of the time you'll win the third. Okay, that's fine. If that really works out that way, then technically in the long run it'll just break even, meaning that you just wasted a bunch of time trying to trade and you broke even, which is better than being a losing trader, but it's still not worth your time because you didn't make or lose money. You probably actually lost money because of commissions. So as you see now, if you have 3 contracts on, your first take partial is at a 1-to-3, because 50% of the time you're going to be losing 3 contracts. So you either need to take all 3 contracts off at 1-to-1 and be just gambling and just get 50-50 coin flip, which makes no sense, Or you need to be if you really want to be profitable, it's dictated by the number of contracts. Okay, because basically, think about it. Half the time you're going to lose 3 contracts, and then, well, I can't say it's half the time, but it needs to kind of work out mathematically to be like as if it were half the time. Even if it's not half the time, then your reward's going to have to be a lot higher so that it would still balance out. But you're going to have to take your first partial off at a 1 to 3, right? That means that one contract winning here is the same amount that you're winning, the same amount that as the time when you lose 3 contracts down here, right? One contract winning 3 to 1 or 1 to 3 is the same as 3 contracts losing a 1 to 3, right? Okay, I hope that makes sense. I'm not going to reiterate again. I hope that I drilled that home. So, and then you would take your next partial at like a 4 to 1, a 1 to 4, and then a 1 to 5, right? If you had like 3 contracts on. Okay, anyway, now let's get into the entry methodology that Coolomaji teaches and how I'm applying it intraday. Well, he obviously enters intraday, but he's looking at a larger time frame. But how you could use this to day trade or to long-term position trade. And this is how I won the day trade I did on Friday. I mentioned in my previous video. Okay, first off, you remember how I taught that there's a DR IDR that the master MAS7ER teaches. Okay, so what he teaches is that 9:30 to 10:30 creates an opening range, and then once it gets closed outside of that, it indicates that either a bias or that the other side has an 80% chance of not being touched. Well, that's pretty wide risk though, right? Well, I found from learning Coolomaji from this guy that there's a much smaller opening balance that occurs in the first 5 minutes of the day. You guys are gonna like this. All right, watch. Open 9:30. 5-minute candle is green. What's your entry methodology? Watch. Watch this. Once the high of that 9:30 candle is exceeded, you go long. Your stop is the low of that 9:30 candle. If you have 2 contracts, you're taking your first partial at a 1 to 2. And then obviously if it doesn't win or lose by the end of the day, you're closing the other one in profit, or if it's in drawdown, right? But so as you can see, it worked out this day, right? 9:30 a.m. high gets exceeded. I jumped in a bit sooner though, because I just had a feeling it was going to be a bullish bias, right? So I was actually more like this. So because I jumped in early, I was able to get my second partial off, because what I chose for that day, what I chose my system to be, was take a partial at 2 to 1 and then take the second contract off at 4 to 1. I just got lucky. It just happened to work out that way because I jumped in a bit early. But even if you'd only taken a partial at 2 to 1, then moved your stop to break even, you still would have won money that day, right? It would have been like this. So that's it. That's really it. Now, okay, I'm not going to give it away yet, but there's other sessions where this happens. But what I'm mainly focusing on is the 9:30 opening balance, because I believe that's the most important one. Now, there is a way to get a little bit more, I would say a lower probability, higher reward with it. And what is that? Use the 925 candle. But there's a caveat to that. You're entering, now, also disclaimer, I would not take short trades very often, especially in a bull market with the NASDAQ. So I'm mostly just looking for long entries. Okay, anyway, if you use the 925 candle, this is what you do. You're entering on the break of the 925 high, but you can't put your stop loss until the 930 candle closes, because often the 930 candle will go below the low of the 925 candle, and it might go below the low after it's exceeded the high. So you'd be entering the break of the 925 candle, waiting. So you're entering the break of that, probably around a little bit 9:30 or after 9:30, but you have to wait till 9:35 for this candle to be formed, and then you know either this candle is going to be the lower low, or this candle is going to have the lower low, and whichever one has the lower low becomes the stop, and then you set your risk reward accordingly. Now, okay, there's plenty of times where you get stopped out with this, but what you will notice is that on not every day where there's massive running, where it runs up massively, but there very often there are days where it runs up massively and it does not violate that low. Now, there's other times where it occurs. Do you see what I'm pointing at now? The 8:30 candle is pretty big because at 8:30 is that's the most common news data release, right? So this might be a sketchier strategy because you don't really usually want to be in during news because stops, like, there's a huge influx of like fake liquidity from banks and stuff. I wouldn't say fake, but just like bank engineered liquidity. Stops don't always get respected, stuff like that. But if you want to just like conceptually look at it, 8:30 is very similar to 9:30. Let's say you did an 8:25 breakout. What would it be? You'd be entering break of the 8:25 candle. Your stop. It's right there. And you'd be looking for whatever risk reward you want, but depending on your contracts. Now, okay, you could also still do the 8:30 candle. It would be wider risk, but let's look at how that played out also. You enter the break of the 8:30 candle to the upside. You put your stop at the low of the 8:30 candle, or maybe the 8:25 candle, but probably just this because that's wide enough risk already. And then you're going to take a partial at a 2-to-1, which it gives you right there. If you had two contracts on, right? So you can see how this is actually, I'm definitely onto something with this, and Coolomagi's definitely onto something. Now, there's one other session. Well, there's other sessions too. If you know about London session, which starts at 3 a.m., there's kind of a similar thing going on. Let's say you had attempted that same trade and you'd held it through the entire day, but you got in at the beginning of London session, or let's say 5 minutes before London, you're waiting for a break of that, but then anyway, you're either going to get, it doesn't get broken at 3 a.m. So maybe the 3 a.m. opening balance, whatever. Regardless, it's not a bullish candle, so maybe you don't even take the trade, but let's just say you're just purely entering based on a break of the high. Okay, and the low of the 255 and 3 a.m. candle is the 3 a.m. candle, so that would be your stop. Now let's just say, I'm not saying that you should do it this way at 3 a.m., but let's just see the RR it gives you by the end of the day, or the highest RR it gives you, if that was your entry. We've got almost a 26. Now you probably would have got out sooner or something, but let's just say you were waiting for this high to get broken again, and you saw this high get established, then you were going to take profit when it gets there again. It doesn't get there again, so then you have to close at end of day. So end of day, you'd have to close there. It gives you about a 19.5 to 1. Right, and you could have held that through London and through New York session, New York open and New York close, or afternoon session, PM session. Does this make any sense? Now, I'm not going to waste a bunch of time going back through the charts, but you will find that quite often this very thing I'm talking about works out. Let's say you did it at 9:25 break. You wait for 9:30 to form. That's your low. Look what happens. You see a high. You see, this is a good exit strategy. You see this high get formed, then it starts to break down. You don't get scared out yet. You wait for them to come run that high one more time. So once it establishes that high, you know that the high becomes the take profit. I'm just telling you guys what I've seen about how the market actually works. Establishes the high, it becomes the take profit. You set your take profit like at that high, or like one tick above the high or whatever. There you go. 11.5 to 1 risk to reward. Or if you did it from the 935 breakout, it's a 3 to 1. So maybe you would have taken a partial at a 2 to 1, and then your next you'd be aiming for a 4 to 1. But maybe this indicates to you to take profit there once it gets back there again. Or you just don't get the 4 to 1 and you stop out at break even there. As you can see, what did they do? See, this is exactly, see how I'm tapping into how the market is actually coded? If you took a partial there and then you were holding for a runner, look what the algorithm does. It comes down and takes out people who are who moved their stop to break even on the exact trade I'm describing, right? See how it does it there and it does it there again? Maybe you didn't get stopped out there, but if you didn't move your stop quite to break even, but by end of day, which is around here, then you would get out of the rest of your position. I hope you kind of are catching on to what I'm describing. I haven't been super practiced with it, so I wasn't the best at describing it, but I hope it makes sense and that you guys are seeing that there's actually a very simple strategy for how to trade the market with a long bias. Now, you'll also see that it doesn't always work though. But the market is deliberately coded to either respect this strategy, but also some days to violate this strategy. So as you can see here, opening candle, the break of that, your stop's there. What does it specifically attack? It attacks that low. It also attacks this low. Now this could get more nuanced. I don't know the data on this or the stats, but as you see though, even though it violated the 930 opening balance low, did it ever close below that net low? No, it didn't. So maybe you'd have a re-entry. This might be a bit tricky. I don't know. This might be too nuanced. I'm going to have to experiment with it. So let's say you got violated there. Well, if I got violated there, I wouldn't have a trust on the bias very much at all. But as you can see, it was another day where the market ripped pretty hard. So clearly somebody who's trading a strategy that's like the one I'm describing, somebody is a good enough trader that they knew to get back in. And my best inkling or my best thoughts on why they knew to get back in is, as far as I can tell, these 5-minute candles never closed below the low. So to me, that means looking for a re-entry. So I don't know. We're going to have to think about where could the re-entry be. Maybe a market structure shift to the upside. That doesn't really happen till here. So maybe that's the re-entry. That's kind of wide risk, but as you can see, even with when there's wide risk, if it's a sure thing, there's a big reward still, right? So I don't know. We'll have to see. There also was a fair value gap entry right there, buying below the low of a red bar. But that would have been a high at the time, so I don't know that's super valid. I think one pretty clear entry would be break of high of day. Now you say, like, usually break of high of day is a failure, but not in the long bias market where breakouts are in a type of phase of the market where it is constantly breaking highs, right? So maybe that's the entry. I don't know if this is the stop. That's pretty wide of a stop, but you can clearly see that it ran up, and once it broke high of day, it broke the IDR, right? If we put on back on the DR, the first hour balance, right? Once it closed above that, it kept ripping, right? So even though the opening balance got taken out, it never closed below it. So maybe at that point, you'd be looking for a break of the DR or whatever high of day is, right? So I don't know. Not all of this is super concrete that I'm sharing, but there's definitely some concrete elements to this. And I think this will help you guys a lot, because ever since I looked at this, it has completely, this past week or two, my eyes have been completely opening to it. I was kind of hesitant to even share this with you guys, because this seems like kind of like a cheat code, but I feel like I have to. If anything, it'll help me get more views on my channel, and hopefully I can get monetized at some point so that I can continue to bring you guys content and make it higher and higher quality as I get better at being a content creator. But anyway, I also looked through previous contracts, and if you don't know how to look through previous contracts on TradingView, you might think they're not there, but they are. So if you wanted to look at a random previous contract, you would just type in the contract in the month and then press enter. Even if it doesn't show up in the search, you press enter and then it'll show up. And some of the older data is a little bit more sporadic. It's not as good, but what you will find is that there still is opening balance stuff going on. As you can see, this was a downside day, but there still was an element of opening balance, right? The 925/930, if you took the break below the 925, maybe, if you had a short bias here, you can tell that that worked out pretty good. Now, I wouldn't have taken that trade because I'm not a short bias trader. But in 2017, this was actually right when crypto was crashing, so maybe you would be looking for that, right? As you can see, this one didn't really work out. It got violated. So again, there's maybe more nuance to it. And I'm not saying this system works all day, every day, or every day, but there's definitely days where it does work. And so, and the key with trading is you're not looking for a way to win every single day. You're looking for a system that wins more money than it loses, correct? So here, it also would have not worked out, right? So you'll definitely have losing days. But I haven't been on this contract, but I've looked at plenty of contracts and I've repeatedly seen this strategy work out. Now you probably have to be in the right market conditions. So doing it during a bull market is probably the best idea, right? Trying to do this last year would have been probably silly, right? You might have wanted a different strategy back then, or be trying to do it down to the short side. Although there were still bull runs last year, so it would have worked there. Probably wouldn't have worked great here. But now that we're in a bull market, it's been working great, right? So anyway, thanks for watching, guys. I hope this helps you. Now, while it does seem to work on futures, I know that this works even better on like individual stocks. So if you're day trading stocks or trading options on specific stocks, definitely look into what I'm talking about and look in that guy's channel. Watch this guy's video, these two videos, and you'll understand it better. And there's a lot of fundamental earnings type stuff alongside it, but I'm just giving you the technical thing that I would be applying to day trading futures. So yeah, take care, guys. Thanks for watching. I'll see you soon.